What's up, guys? It's Chris with Cross Country. Today I'm going to show you how to get an 800 plus credit score, which, by the way, is the threshold in which most people would consider it to be a perfect score. Here's why all this matters in the first place. Your credit score is really just a report card of how well you handle your money. Like in school, you'll do well on exams, you'll do well on tests to get a good grade, but in life, if you handle your money responsibly, you get a good credit score. And having a good credit score isn't just something you look at online, it actually has a practical purpose where it could save you a lot of money. And even better, it can end up making you a lot of money. Having a good credit score means you get the lowest interest rate anytime you want to leverage your money in real estate and business or just in life. It's how I'm able to get such low interest rates anytime I go to buy something. It's effectively as though I'm getting free money. It's also how I get approved for pretty much any credit card sign-up bonus I apply for, which is just another way that I get more free stuff. So this video could easily save you or make you tens of thousands of dollars over your lifetime if you actually just follow it and do it. It's not going to take you a lot of time. It's super easy to do. And the best part about all of this is that it's not going to cost you any money out of pocket to get an 800 score. So it's entirely free to do it. Again, it's just gonna take a little bit of your time, and all I ask for in return is a quick like on the video to help with the YouTube algorithm. And if you're feeling a little bit generous today, maybe a quick comment down below. Help us boost it up too. So if you wouldn't mind, just hit the like button and a quick comment, and that's it. Otherwise, just enjoy the video. Now first, in order to understand how you can get a perfect score, you've got to understand how the system scores you in the first place. That's why I said, just like you've got a class that grades you differently for homework, for test assignments, for attendance, and whether or not you actually smash the like button, your credit score grades you several different factors as well. So if you want a perfect score, you have to do well on all of them, and there are 5 components the credit gods use to calculate your credit score. First is your on-time payment history, and this makes up 35% of your credit. Now, this one is incredibly straightforward. Just don't miss a credit card payment and don't pay it off late, ever. In order to get a perfect credit score, you'll want to not miss a payment, otherwise that could set you back. Now, here's how this works and how it's calculated. The credit gods look at all of your on-time payments and then divide that by your total payments. And then from that, they calculate what percentage you paid on time. Now, here's just an example. Let's say you've had one credit card for 60 months and you end up missing one payment. That means the credit overlords take 59 on-time payments, divide that by 60 total payments, and you have a 98.3% payment ratio. And as you can see from the Credit Karma score calculator, that puts you in the yellow, which is not good. That is unacceptable. If you want to get a perfect score, however, in a different example, let's say you've now had 2 credit cards, each for 60 months, and you end up missing one payment. Well, now you have a total of 120 credit payments between 2 credit cards, which means that they take 119 on-time payments, divided that by 120 total payments between the 2 cards, and that means you paid 99.1% on time, which puts you in the green category. And as far as Credit Karma is concerned, which is a little bit better, and is one more example, let's just say you're brand new to building credit, you have one credit card, you've had it for 15 months, and you end up missing one payment. Well, the same calculation still applies. You have 14 on-time payments, divide that by 15 total payments, and that means you've only paid 93.3% on time, which is bad. That's really bad. It's in the red according to Credit Karma, which means you can't pass go, you can't collect $200, and you got to go right to credit jail. All right, maybe not that bad, but also means that you could prevent this from happening by not only just not missing payments in the first place, but also having more credit available to you for a longer period of time. So that way, if you do miss a payment, it does not end up impacting you like having 10 credit cards open for 5 years would give you 600 total payments. So that if you end up missing one by mistake, it still means you paid 99.8% on time, which is not the end of the world. Now, when it comes to paying off a credit card on time, the really good news with this is that for them to count it as an on-time payment, you just have to make the minimum, which, every single month is usually around 2% of the balance, so $25 to $100 a month. So even in the worst case scenario, if you can't afford to pay off your credit card bill in full, just make the minimum payment on time every single month, and that will help you keep your score intact in this category. Which, like I said, all of this is the most important part of your score making, up to 35%. Just ask Dave Ramsey. If you do miss a payment, don't fret. Eventually it will fall off your credit report, but it will take time. So moral of the story, pay off your credit card balances each month and on time. Second factor that makes up your credit score is known as what's called credit utilization. That makes up 30% of your score. Now, in order to get a perfect score, the credit bureaus will just want to see that you're not out there just maxing out all of your credit cards and that you're only using a small percentage of the overall credit that you have available to you. Ideally, you want to be spending under 10% of your total credit limits, showing the almighty credit gods that you don't need all the money they've given you because you're that good with money. Now, if you're confused, here's how this one works, and here's how it's calculated. Let's just say you have a credit card with a $10,000 limit, and you go out there and you spend $6,000. And then after that, you just make the minimum payment. Well, at that point, you do the calculation, and you're using 60% of the available credit you have, which puts you in the red category here, which is bad. And from that, you're seen as a riskier borrower because you're carrying a high balance, and that makes the credit gods very angry. And they're going to lower your score. On the other hand, if you have the same one credit card with $10,000 limit, you spend $6,000, but you pay it off in full when it's due, that means you now have a $0 balance on a $10,000 credit line, which shows that you have a 0% credit utilization rate, which makes the credit bureaus very happy, gives you a green category. Now, there are some ways around this because it's not the dollar amount that the almighty credit gods care about. It's actually the percentage of credit that you use. So this means if you have a $300 credit line and you go out and spend $300, that just means you've maxed out your credit. You have a 100% credit utilization rate, and that's very bad. But if you go and spend the same $300, although this time you have a $30,000 credit line, then that's showing that you only have a 1% credit utilization, which is really good. Now, one of the techniques that I use to help with this is just to have a lot of available credit with really high limits. For instance, right now, I have 5 credit cards. Most of them have over a $30,000 credit line. Now, I'm never, ever going to actually spend that much money on credit, but it does help me in the instance where I go and spend $10,000 or more for bridge financing, and I can still show a very low credit utilization rate because I have so much credit already available to me. Now, there's a myth out there that suggests you should keep a small balance on your credit card at the end of every month, so that way the credit bureaus have something to report. And this one is completely false. Keeping a balance on a credit card is not going to help improve your score, and if anything now, it's going to cost you more money in the interest that you pay. So it's always better to pay it off in full by the time it's due and never carry a balance on a credit card, ever. So if you want to get a perfect credit score, it's really important that you try to keep a balance of 5% or less of your available credit line. It doesn't mean that you can't go out there and spend more than 5% of your available credit, but it does mean that you should pay it down before the statement cycle is over, so that way the credit bureaus have less money to report on. Now, in addition to that, it will help you to go and get more credit. As counterintuitive as that is to say, getting more credit will help increase the total credit limit you have available to you, which will decrease your overall credit utilization. And finally, I strongly recommend you ask for a credit limit increase every 6 to 12 months on your existing credit cards. This way you're going to be constantly lowering your overall credit utilization, you're increasing your available credit, and you're not having to go through the credit application process, which will cause a hard inquiry. So just remember, don't go out there spending more money just because you have more credit available to you. That's the catch. I think that goes without saying. All of this really should be done as a tactic or a strategy to help increase your credit score and not to go out there and buy things you don't need. And finally, one more note I want to leave off with this category. How much money you keep as a balance on a credit card is really only going to be a temporary situation. This is one of the things that's only going to impact your score until you pay down your credit card. And then your score will end up going up afterwards. So if you have a high utilization rate right now or in the short term, it's not the end of the world. And your credit score will improve as soon as you pay it down. Third category, they say that length doesn't matter. But when it comes to calculating your credit score, it very much does, because 15% of your overall credit score is made up by the average length of your credit history. This just means the longer that you've had credit and the sooner you start building credit, the better. This is one of the reasons I highly recommend people to build their credit as soon as they possibly can, even if it means going and getting a credit card the day you turn 18. This will build the entire foundation of your credit history very early on. Now, it's very important for me to distinguish here that this is calculated by the average length of your total credit history and not the total length. And let me explain that. Let's say opening one credit card 4 years ago, that would mean your average credit history shows as 4 years. But if you opened that one credit card 4 years ago and then you opened up another credit card today, your average credit history would now be reduced to 2 years. So remember, because it only takes the average, the same also applies if you end up closing an old credit line. Because some people believe it's a good idea just to close old credit cards they don't use anymore. This could be really bad because once you close off an old credit card, even though it'll still show in your account for 7 to 10 years, it could lower the average age of your accounts after that, and then you would have to wait even longer to build it back up. So my recommendation is to first start building your credit as soon as you possibly can and keep all of those accounts in good standing as long as possible. This is going to help you build up a solid fortress of long-standing credit, so that when you do go and apply for new credit, it's not going to impact your credit score, your account as much, since you have a lot of long-standing credit history already. Because of all that, it's going to reduce your score a lot less. And when it comes to doing all of this, really the only thing you can do for this category at this point is just wait. This part of building your credit just takes time. So don't be impatient. If you've just got a credit card, made a few on-time payments, and don't yet have a 760 FICO score, patience goes a long way. Sometimes you're just going to need to wait this one out, and in terms of how long you'll need to wait, according to Credit Karma Guide, they want to have 9 years or more of average credit history to get the best possible ranking. So it takes time. And even for me, my average account length shows just over 17 years because of all the new credit I've taken out recently with interest rates as low as they are, and still it doesn't make a huge difference because it only makes up 15% of my total credit score. And I've done every other category very well. The fourth aspect of your credit score is how many lines of credit do you have open? And this makes up 10% of your score. Now, this is one of those things that you would think makes absolutely no sense. Like, why would we go and reward someone for going and opening up more credit cards and taking out more loans? You would think that the person who doesn't really need any credit and doesn't have much would have the highest score, right? But if you think that way, you'd actually be wrong. And here's why. First, the more credit you have, the higher your credit limit will be, which means the lower your overall credit utilization is likely to be. Which means the higher the score you'll have. The second, by having more credit available, you're going to be able to show more on-time payments, which, like I said, is going to help increase your score as well. And third, having a mix of credit, like having a mortgage, an auto loan, and a credit card, shows lenders that you can responsibly handle different types of debt without defaulting on them. All of this sounds like pretty backwards thinking, and a lot of it reminds me of the mindset of we're only going to loan people money who don't need money because they're the most likely to pay us back, and that, by the way, is very true with banks. They love lending you money when you don't need it, and as soon as you do need the money, you're seen as a higher risk because you need it. So really, this is just something that you have to lean into. It's how the system works, and according to Credit Karma, they want to see you with 21 lines of credit or more to have the perfect score. And for most people, I have a feeling this is going to take you a very long time to build up to, but I wouldn't stress about it too much because, again, it only makes up 10% of your score. Although I would recommend you aim to diversify your credit profile over time, because long term, that is going to help you get an 800 plus credit score. Finally, the fifth component we have of your credit score, which makes up the remaining 10%, and that would be the total amount of inquiries on your credit. Now, here's how this one works. Anytime you go and apply for new credit, it's reported to the credit bureaus and shows up on your reports. What's called a hard inquiry. This helps lenders keep track of how many times you're going and asking for credit, and generally speaking, the more times you're going and asking for credit, the riskier you become as a borrower. This is because lenders are worried that all of a sudden you're out there going and applying for new credit cards and loans, and they're concerned that maybe something has happened that is causing you to do this. Thinking, why did you just get 3 credit cards and an auto loan today? Are you running out of money? Are you planning on breaking bad, going all of a sudden, max it out and then never pay it again? This all seems worrisome to lenders, so therefore the more hard inquiries you have on your credit report, the lower your score is. Now, generally going to be in addition to that, if you're out there getting credit cards and getting loans, that is going to reduce your average credit length history, which could end up further dropping your score as well. That's why so many people end up telling me that they've just opened up a new credit card and then all of a sudden their score drops like 50 points. No, it was not just the inquiry that did that, it was also the reduction in your total average length of your credit history that impacted your score as well. So the inquiry was really only a small component of that. The good news, however, is that all of this is really just a temporary thing, because hard inquiries only show up on your report for the first 2 years, and they only impact your score for the first 12 months. Then after that, they drop off your report like it never even happened. The other good news with this is that if you're shopping around for an auto loan or a mortgage, and you'll need to run your credit multiple times with different lenders to get different rates, the FICO scoring method will generally just group all of those inquiries together as one hit, and therefore it's only going to impact you if you ran your credit score just once. So that way you can go to 5 different lenders for an auto loan, have them all run your credit 5 times. It's only going to count as if you're running it once, of course, as long as you do it within a relatively short period of time, like a couple weeks. This is to promote rate shopping for you as the customer without penalizing you with your credit score. But again, this only makes up 10% of your overall credit score, so it's pretty minimal. But ideally, if you're gonna want the Credit Karma green score, they want you to have 0 hard inquiries in the last 12 months. Now, realistically, I think having 0 inquiries in the last 12 months is rather ridiculous, especially if you're out there going and getting like credit cards and getting bonus points and all of that sort of stuff. So I think as long as you keep it to a minimum and are rather selective about the new credit you get, you should be fine. And also, if you're in the process of going and building up your credit, it's probably best you go and take out a lot of credit now while you still can, so that way, by the time you actually need a good credit score to like buy a house, all the hard inquiries will have dropped off your report. Anyway, this is exactly what I ended up doing. I took out a whole bunch of credit when I was younger, as early as I possibly could, when I knew I was still building up my credit. So that way, a few years later, I knew when I needed credit score, like to buy a house, it wouldn't have mattered near as much. Then once you've done all the above, I have a few final recommendations. First, I would highly recommend you check your credit score every few weeks using a free service, usually provided by your credit card company. They update your credit score every week or so. And even though it's not going to be exact, it's going to use the exact FICO scoring method. It's still going to give you a pretty close indication and going to give you a great representation of how you're doing credit score-wise. The second, you could try a technique to increase your credit score known as credit piggybacking. Now, this is where you become an authorized user on a credit card from someone who has a very extensive credit history, typically a parent. Now, when you do that, their credit history could report on your credit account as well, and that might increase your credit score a lot in a short term. It's very important to note that not all credit card companies will do this, and the FICO scoring method has been cracking down on people trying to do this to boost up their scores artificially. I personally think it's probably better you just build up your own credit reports on your own. And lastly, following everything in this video, staying consistent with it, and keeping very precise with how you manage your credit will end up helping you get a perfect score and end up saving you a lot of money and making you a lot of money. If you learned something new today, smash that like button for the YouTube algorithm. Thank you so much for watching. I really appreciate it. As always, if you guys enjoy videos like this, make sure to subscribe, hit the notification button so YouTube notifies you first anytime we post a new educational video. Thank you again for watching. Until next time.